In the world of big data and AI warfare, there's one name that keeps turning heads: Palantir Technologies. But is this tech giant truly a futuristic goldmine, or just an overhyped bubble? Let's decode the numbers behind the hype and reveal what's solid and what's not in Palantir's rise to power. Market cap: $281 billion. Palantir is now worth more than some nations' GDPs. But wait, this valuation is based on just $3.1 billion in revenue, which means investors are paying a massive 87 times sales. That's a red flag for overvaluation. Year return, plus 456.78%. The stock has skyrocketed more than 450% in just 1 year. That's mind-blowing, but such sharp rises often come with sharp corrections. Be cautious of momentum-driven rallies. Revenue, TTM, $3.12 billion, with a 33.45% year-over-year growth rate. Palantir's sales machine is accelerating. This is a healthy and sustainable trend. Net income, $570 million. Palantir has finally turned profitable. After years of bleeding cash, this shift to black is a major milestone. EPS, $0.23 per share. Earnings per share are still low. This EPS doesn't justify the high stock price, making the PE ratio skyrocket. PE ratio, 492.71, TTM, 193.61, forward. These are absurdly high numbers. Even the hottest growth stocks usually trade under 100x forward earnings. This is classic bubble territory. Gross margin, 80.01%. A huge positive. Software firms usually enjoy high margins, and Palantir is no exception. This gives them room to reinvest and scale. Operating margin, 13.02%. Change profit margin, 18.32%. Both are improving, but still not outstanding. Compared to mega tech players, Palantir is playing catch-up. Free cash flow, $1.32 billion. The company is generating strong cash. That's fuel for innovation and long-term resilience. Price-to-sales ratio, 87.36. Investors are paying $87 for every dollar in revenue. That's insanely high. Most healthy companies trade between 5 to 10x. Clear sign of overvaluation. Price-to-book ratio, 51.83. That's 52x its book value. One of the highest PB ratios you'll ever see. EV over EBITDA, 633.98. Another extreme multiple. Even for hyper-growth tech, this screams priced for perfection. Total cash, $5.43 billion. Total debt, $244 million. Palantir is flush with cash and nearly debt-free. This is a huge green flag for stability. Net cash, $5.19 billion. The balance sheet is rock solid. They can survive tough markets and still invest aggressively. Insider ownership, 7.45%. Founders and top leadership still hold meaningful stakes. This shows confidence from within. Institutional ownership, 48.34%. Almost half of the shares are held by big institutions. That's a positive sign for credibility and investor trust. Shares, outstanding, 2.36 billion. Share float, 2.18 billion. That's a huge number of shares in circulation. More shares equals more dilution risk for retail investors. Share dilution, YOY, 6.2%. The company has been issuing new shares, diluting existing ownership. That's not a good trend for long-term holders. Analyst consensus, hold, average target, $88.17. Even after this massive rally, analysts see downside from here. Most are calling for a hold, not a buy. So here's the truth. Palantir is innovative, profitable, and financially strong, but it's also massively overvalued and could be walking on a tightrope of hype. Would you invest in a company priced for perfection or wait for a correction? Let me know in the comments and follow for more deep dives into the world's most talked about stocks.